Welcome back to another explainer. So today we're diving into Caterpillar. Now, when I say Caterpillar, you're probably picturing, hard hats, construction sites, and those massive yellow earth movers. But their recent explosive stock performance, it actually has nothing to do with digging dirt. It's all tied to a hidden tech engine. Let's unpack this incredible surge together. I mean, get a load of this number. Over the past year, Caterpillar's stock has surged a staggering 172%, rocket shipping from $388 to over $1,000 a share. That kind of rapid, explosive appreciation, it's just incredibly rare for a mature, heavy machinery stock. Literally unheard of. Which naturally brings us to the central mystery we're unpacking today. How on earth did an old-school industrial company, one famous for tractors and mining equipment, suddenly transform into an AI darling trading at a tech-like forward multiple? The market is pricing Caterpillar like a high-growth tech stock, and we absolutely need to understand exactly why. Section 1. Record-breaking Q1 results. To justify a stock surge of this magnitude, you need hard financial data, right? Well, the sheer scale of this financial jump is staggering. Think about the jump in sales comparing the first quarter of 2025 to 2026. It's a leap from $14.2 billion to $17.4 billion. That's a massive 22% increase year over year. And following right along, their operating profit jumped 20% to a cool $3.1 billion. So the fundamentals underlying this crazy stock price are undeniably strong. Section 2. The $63 billion backlog. But past performance is only part of the story. Investors are paying for the future, and that future sits at a record level $63 billion. To put that into perspective, that backlog is up 79% year over year. When a company has a guaranteed pipeline of $63 billion in orders just waiting to be fulfilled, well, it completely strips out the traditional volatility of manufacturing. For investors, this means massive forward momentum and a really substantial safety net against economic bumps. Honestly, though, it's not just the size of the backlog, it's the quality of the revenue it represents. The absolutely crucial point here is Caterpillar's shift toward what we call software-like service economics. They aren't just selling a big machine and walking away anymore. No, they're generating highly recurring, low-volatility revenue through telematics, digital diagnostics, and long-term maintenance. Essentially, they're building a whole digital ecosystem around their physical products. To really grasp the scale of this, consider their 1.6 million connected assets operating globally right now. That's a lot of machines pinging data. Caterpillar isn't just selling a tractor. They're essentially selling a digital subscription for diagnostics and maintenance. Because these machines are smart and connected, they enjoy incredibly high service attachment rates. And this recurring revenue is structurally way more profitable than just fabricating raw equipment. Actually, it's exactly this software-like profitability that's driven their structural margin improvement, pushing their adjusted net income margins all the way up to 14.5% over the last 12 months. Section 3. The AI data center play. Now, here we hit the absolute core catalyst for this stock surge. Historically, the market valued Caterpillar based on traditional, cyclical, earth-moving equipment. If the economy was building, Caterpillar was selling. If construction slowed down, well, the stock took a hit. It was a classic, purely cyclical model. But the new reality completely changes the picture. Forget the tractors for a second. The real AI driver here is mission-critical gas turbines and backup power generators. The whole artificial intelligence boom requires massive, sprawling data centers, right? And those data centers require immense, uninterrupted power. Enter Caterpillar's energy and transportation segment. They're providing the turnkey power arrays that are literally keeping the AI revolution online. I really want to highlight this quote from the Traphus analysis because it completely unlocks why this is so insanely profitable. Because hyperscalers prioritize guaranteed 99.999% uptime over baseline equipment cost, Caterpillar enjoys immense pricing power. Think about it. If you're a tech giant running billions of dollars of AI compute, you absolutely cannot afford a power failure. You don't haggle over the price of a backup generator. You gladly pay a premium for absolute reliability. So this is the exact paradigm shift that Wall Street is currently pricing in. Old Cat was valued as a cyclical earth mover tied to housing and infrastructure. New Cat, it's valued as a provider of mission-critical, turnkey AI-powered infrastructure. The business model has fundamentally changed, and the perceived market value has shifted right along with it. Section 4. The Road to $2,000. So what does this all mean for their future valuation? Let's walk through the math behind these projection scenarios. If we assume their earnings hit $35.50 by 2028, even with a modest valuation contraction down to 49 times, we're still looking at a $1,740 stock. If they preserve their current premium multiple, thanks to that high revenue visibility we talked about, the target is 1,867. And if we look out to the long-term bull case in 2029, where earnings cross $40 a share, maintaining a 50x multiple makes a $2,000 stock price mathematically achievable. Crazy, right? But to hit those ambitious targets, Caterpillar needs to execute a really specific strategic path to get to an 18% net margin profile by 2028. First up, they need their revenue growth to just keep outpacing their baseline fixed operating costs. Second, they absolutely must maintain and dominate that mission-critical pricing power with those AI data center clients. And third, they need to successfully expand volume at their Lafayette facility so they can actually handle the massive scale.
Section 5. Dividends and Future Outlook.
We'll wrap up our explainer today by looking at dividends and the broader outlook. Because honestly, even with this heavy pivot toward tech infrastructure, Caterpillar hasn't forgotten its core investors. Amid all this growth and massive capital expansion, they still deployed an incredible $5.7 billion directly back to shareholders in the first quarter alone. I mean, that demonstrates immense cash flow strength. They're successfully funding a high-tech evolution while still heavily rewarding their investors. Looking at the big picture, analyst consensus models 2026 expected revenues at $75.8 billion, a really solid 7.1% increase. By 2030, they're targeting nearly 3 times their large engine capacity compared to 2024 levels, literally just to keep up with power generation demand. Of course, no investment is totally without risk. We definitely still have to watch out for macroeconomic headwinds, raw material tariff complexities, and localized dealer inventory changes. But the growth trajectory is undeniably powerful, making this an absolutely crucial stock for investors to monitor closely. Which leaves us with a totally fascinating question to ponder. Is Caterpillar's incredible structural re-rating just a unique anomaly because they happen to make giant generators? Or are we witnessing the start of a broader industrial supercycle, where traditional legacy manufacturers find completely new life as the physical backbone of the AI revolution? It's definitely something to keep an eye on. Thanks so much for joining me on this explainer, and I'll catch you on the next one.